Look, I need you to understand something that's happening right now in the silver market. Not next month, not next year, right now. And if you're sitting on the sidelines waiting for the perfect moment to stack silver, that moment might have already passed you by. Let me paint you a picture of what's unfolding. Silver just hit $64 an ounce. Read that again. $64. We're not talking about some modest uptick or seasonal fluctuation. We're talking about silver more than doubling in 2025, reaching all-time highs that have analysts scrambling to revise their forecasts upward every single week. But here's what keeps me up at night, and what should have your attention right now. This isn't just a price story. This is a supply story. And supply stories in precious metals, they don't end well for people who wait. The Silver Institute just confirmed what many of us have been tracking for years. We are now in the 5th consecutive year of supply deficits. 5th year. Think about what that means. For 5 straight years, the world has been consuming more silver than it produces. Every single year since 2020, we've been drawing down existing stockpiles just to meet demand. And those stockpiles, they're not infinite. They're not even close to what people think they are. Let me take you back to 2020 for a moment. The world was shutting down. Economies were grinding to a halt, and yet silver demand didn't collapse. It accelerated. Why? Because silver isn't just a monetary metal anymore. It's become absolutely critical to the technological infrastructure of modern civilization. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. Every 5G tower, every smartphone, every computer server, every medical device. Silver's unique properties, its unmatched electrical and thermal conductivity, its antibacterial characteristics, make it irreplaceable in thousands of industrial applications. And here's the kicker. As we've been pushing toward green energy, as governments worldwide have mandated the transition away from fossil fuels, as electric vehicle adoption has accelerated, industrial demand for silver has exploded. We're not talking about a gradual increase. We're talking about a structural shift in how much silver the global economy requires just to function. The solar industry alone is projected to consume over 200 million ounces of silver annually by 2030. That's nearly a quarter of total global silver production going to just one sector. One sector. Now you might be thinking, okay, but can't they just mine more silver? Great question. And here's where this story gets really interesting. Silver production isn't like turning on a faucet. You can't just decide to mine more silver because the price went up. Most silver, about 70% of it, comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver production is largely dependent on the economics of those other metals, not silver itself. When copper mines shut down because copper prices are weak, silver production drops. When lead and zinc operations scale back, silver supply contracts. The primary silver miners, the ones actually targeting silver deposits, they only account for about 30% of global production. And many of those operations are mature mines with declining ore grades. Starting a new silver mine? You're looking at 7 to 10 years from discovery to production. Minimum. And that's if you can navigate the permitting process, secure financing, and deal with increasingly strict environmental regulations. The pipeline of new silver projects is thin, dangerously thin. Meanwhile, existing mines are facing rising costs, energy costs, labor costs, equipment costs. The all-in sustaining cost for many silver miners is now approaching $20 to $25 per ounce, and some of the older, easier-to-access deposits are depleting. Miners are having to dig deeper, process lower-grade ore, and spend more to extract the same amount of silver. So we have this perfect storm brewing. Demand is surging, driven by industrial applications that aren't optional. Supply is constrained by the economics of byproduct mining and the long lead times for new projects. And inventories are being drawn down year after year. But wait, there's more to this story. Because while industrial demand is eating up supply, there's another force at work. A force that's been quietly building and is now starting to show its hand. Central banks are buying silver. Now, central banks have always been gold buyers. That's well documented. But silver? That's new. That's significant. And it tells you something about how sophisticated institutional players view what's coming. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about de-dollarization anymore. They're actively building alternative monetary systems. And silver, with its historical role as money and its industrial necessity, is becoming part of that conversation. China has been particularly aggressive. Chinese silver imports have been running at record levels. The Shanghai Gold Exchange, which also trades silver, has seen massive physical deliveries. And here's what's fascinating: that silver isn't being re-exported. It's staying in China, disappearing into private hands, into industrial stockpiles, into vaults. India, the world's second most populous nation, has a cultural affinity for precious metals that goes back thousands of years. Indian silver imports have been surging. Wedding season, festival season, investment demand, it all adds up. And like China, that silver isn't coming back to Western markets. So you've got industrial demand that's structural and growing. You've got supply that's constrained and struggling to keep pace. You've got inventories being depleted. And now you've got institutional and sovereign accumulation. The COMEX, the major futures exchange where silver is traded, has seen its registered inventory, the silver actually available for delivery, drop to levels that would have been unthinkable a few years ago. We're talking about inventory that could be exhausted in weeks if a significant number of contract holders demanded physical delivery. And that's the thing about paper silver versus physical silver. There's a massive amount of silver traded on paper, futures contracts, ETFs, certificates. But when push comes to shove, when people want actual metal in their hands, the available supply is a fraction of what the paper market suggests. We saw a preview of this in early 2021. Remember the Reddit silver squeeze? Retail investors, frustrated with market manipulation and inspired by the GameStop saga, decided to buy physical silver. And what happened? Premiums exploded. Dealers ran out of inventory. Mints couldn't keep up with demand. The U.S. Mint had to ration silver eagles. That was a relatively small group of retail buyers. Imagine what happens when institutional money, when sovereign wealth funds, when pension funds decide they need physical silver exposure. The available supply would evaporate overnight. Now let me tell you about something that happened in 1980. Silver hit $50 an ounce. Adjusted for inflation, that's over $180 in today's dollars. The Hunt brothers, trying to corner the silver market, drove prices to levels that seemed insane at the time. But here's what's different now. In 1980, silver's primary use was photography, silverware, and jewelry. Industrial applications were limited. There was no solar industry, no electric vehicle revolution, no 5G infrastructure. The demand dynamics were completely different. Today, silver is mission-critical to the global economy in ways it never was in 1980, and yet we're nowhere near those inflation-adjusted highs. At $64, we're not even halfway there. Some analysts are now openly discussing $100 silver, not as a wild speculation, but as a reasonable target based on supply-demand fundamentals. Keith Neumeyer, CEO of First Majestic Silver, one of the largest primary silver producers, has been vocal about the supply crisis. He's talked about how the silver market has been manipulated for years through paper trading, keeping prices artificially suppressed. But he's also said that physical reality always wins eventually. And when it does, the price adjustments can be violent. We're seeing signs that the paper market's grip is weakening. The disconnect between paper prices and physical premiums is widening. Dealers are charging $5, $6, even $7 over spot for physical silver coins and bars. That spread tells you something. It tells you that the real market, the physical market, is tighter than the futures market suggests. And here's where the closing window comes in. Right now, you can still buy physical silver. It might cost you a premium, but it's available. Dealers have inventory. Mints are producing. You can make a decision today and have silver in your hands next week. But what happens when that changes? What happens when the supply deficit becomes so acute that physical silver becomes genuinely scarce? What happens when premiums don't just widen, but when metal simply isn't available at any reasonable price? We've seen this movie before with other commodities. Palladium went through a supply crisis. Prices went from $500 to over $3,000. People who waited, thinking they'd buy on a dip, never got their chance. The dip never came. The metal just kept climbing as industrial users scrambled to secure supply. Silver is different because it's both an industrial metal and a monetary metal. It has this dual nature that makes it unique. When industrial users are competing with investors for the same limited supply, prices can move in ways that defy traditional analysis. Let me talk about something that doesn't get enough attention: the energy transition that governments are mandating. It's not optional, it's policy. The European Union has set aggressive targets for renewable energy. The United States, through the Inflation Reduction Act, is subsidizing solar installations and electric vehicles. China is building solar capacity at a pace that's hard to comprehend. This isn't a trend that's going to reverse. This is the direction of global energy policy for the next decade at minimum. And every single solar panel, every single electric vehicle, every single piece of that infrastructure requires silver. The Silver Institute estimates that solar demand alone could consume 15% to 20% of total silver supply by 2030. Electric vehicles could account for another significant chunk. And that's before you factor in all the other industrial applications: electronics, medical devices, water purification, the list goes on. So you have this massive policy-driven demand surge coming. It's not speculative. It's not dependent on consumer preferences. It's mandated by governments and backed by trillions in subsidies and infrastructure spending. And the supply? The supply is what it is. You can't mandate more silver production. You can't subsidize it into existence. It takes years to bring new mines online, and the economics have to work for mining companies to even attempt it. Now, I want to address something that I know some of you are thinking. But what about recycling? Can't we just recycle silver to meet demand? Yes, silver is recyclable. And yes, there is a recycling industry. But here's the reality. Much of the silver used in industrial applications is used in such small quantities, spread across so many products, that it's not economically viable to recover it. The silver in your smartphone? It's there, but extracting it costs more than the silver is worth. Photography used to be a major source of recycled silver, but photography has gone digital. That recycling stream has largely dried up. Jewelry and silverware can be recycled, but that depends on people choosing to sell, and cultural attitudes toward precious metals, especially in Asia, mean that silver tends to accumulate in private hands rather than return to the market. Recycling will help at the margins, but it's not going to solve a structural supply deficit. Not even close. Let me tell you about what's happening in the investment world right now. Silver ETFs have seen significant inflows. The largest silver ETF, SLV, has been adding to its holdings. But here's what's interesting. Some of the smartest money in the world is moving beyond ETFs and into physical metal. Why? Because ETFs, while convenient, are still paper claims on silver. You don't own the metal. You own shares in a fund that owns metal. And in a real supply crisis, in a scenario where physical silver becomes genuinely scarce, those paper claims might not be worth what you think they're worth. Sophisticated investors are buying allocated storage. They're taking delivery. They're holding metal in their own names in secure vaults. That's a tell. That's a signal that the people who understand markets at the deepest level are preparing for something. And it's not just investors. Industrial users are starting to panic. Companies that use silver in manufacturing are building strategic stockpiles. They're securing long-term supply contracts. They're paying premiums to ensure they have the metal they need to keep their operations running. When industrial users start competing with investors for physical metal, that's when prices can really move. Because industrial users have no choice. They need the silver. They'll pay whatever it takes. Their entire business depends on it. Now, let me bring this back to you. If you're someone who's been thinking about stacking silver, if you've been watching the market, waiting for the right moment, I need you to understand that the window is closing, not because I'm trying to create urgency for the sake of it, but because the fundamentals are screaming that we're approaching a tipping point. 5 years of supply deficits, record industrial demand, institutional accumulation, depleting inventories, rising production costs, limited new supply coming online. Every one of those factors, in isolation, would be bullish for silver. Together, They create a setup that we might not see again in our lifetimes. And here's the thing about supply crunches in physical commodities. They don't announce themselves with a press release. They don't give you a warning. One day you can buy metal, the next day dealers are out of stock, premiums have doubled, and you're on a waiting list that's months long. I've been in this market long enough to see it happen. In 2008, during the financial crisis, physical silver became nearly impossible to find. Dealers were sold out. Mints couldn't keep up. People who wanted to buy couldn't, regardless of price. The metal just wasn't available. In 2020, when COVID hit and people realized the financial system was more fragile than they thought, the same thing happened. Silver Eagles were commanding $10 to $15 premiums over spot, and that was when spot was $25. People were paying $35 to $40 for coins that normally sold for $27 or $28. We're at $64 now. If we see another supply shock, if physical demand overwhelms available inventory, what do you think premiums will look like? What do you think availability will look like? Quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, and you're concerned about what we're discussing, I put together a free guide on how gold and silver IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. Okay, back to where this is headed. The technical picture on silver is equally compelling. We've broken through major resistance levels. The $50 level that held for years, blown through. The all-time high from 1980. We're approaching it in nominal terms, and we're nowhere close in inflation-adjusted terms. Chart analysts are looking at this move and seeing the potential for a parabolic phase. That's when a market doesn't just trend higher, but accelerates, going nearly vertical as momentum builds on itself. We saw it in Bitcoin in 2017 and 2021. We saw it in GameStop in 2021. We saw it in silver itself in 1980. The difference is, this time it's backed by fundamentals. This isn't speculation or a short squeeze. This is real supply and demand. This is the physical world asserting itself over the paper market. And when physical reality takes over, when the paper market loses control, prices can move faster and further than anyone expects. Because the paper market has been suppressing prices for years through unlimited selling of futures contracts. But you can't deliver paper silver to a solar panel manufacturer. You can't put paper silver in an electric vehicle. You need the real thing. The COMEX has been the mechanism for price discovery in silver for decades. But what happens when the COMEX inventory gets so low that its credibility as a delivery mechanism comes into question? What happens when industrial users and investors start bypassing the COMEX entirely and going directly to miners, to refiners, to dealers for physical metal? We're starting to see that shift. More and more transactions are happening outside the traditional exchange system. Private deals, direct purchases, long-term contracts. That's a sign that the market structure is changing, and when market structure changes, prices can reprice dramatically. Let me tell you about the geopolitical angle, because it matters. The United States and its allies have weaponized the dollar. Sanctions, asset freezes, swift exclusions. The rest of the world has been watching and taking notes, and they've decided they need alternatives. Gold has been the obvious choice. Central banks have been buying gold at record levels. But silver is more accessible. It's more affordable for smaller nations and private citizens, and it has that industrial utility that makes it valuable beyond just being money. The BRICS nations are exploring a commodity-backed currency. Silver is part of that conversation. If even a fraction of global trade starts settling in a silver-backed or silver-inclusive currency system, the demand implications are staggering. And it's not just BRICS. Countries around the world are diversifying their reserves away from dollars. They're buying gold, yes, but they're also accumulating silver. Because silver is real. It's tangible. It can't be printed. It can't be inflated away. And in a world where trust in fiat currencies is eroding, that matters. The dollar's purchasing power has been declining for decades. We all feel it. Groceries cost more. Gas costs more. Housing costs more. Everything costs more. And yet, We're told inflation is under control, that it's transitory, that everything is fine. But people aren't stupid. They see what's happening, and they're looking for ways to preserve their purchasing power. Precious metals have been that answer for thousands of years, and silver, with its lower price point compared to gold, is accessible to regular people in a way that gold sometimes isn't. You can buy an ounce of silver for $64. An ounce of gold? You're looking at over $2,600. For someone just starting to stack, for someone who wants to accumulate real wealth but doesn't have tens of thousands to deploy, silver is the entry point. And that accessibility is part of what makes silver so powerful. When millions of regular people decide they want to own physical silver, when they start stacking even small amounts consistently, the impact on available supply is enormous. Because, unlike institutional buyers who might trade in and out, retail stackers tend to hold. They accumulate. They don't sell. That silver comes off the market. It goes into safes, into closets, into safety deposit boxes. And it doesn't come back. Not at these prices. Maybe not at any price. Because for many stackers, it's not about making a profit. It's about having something real, something tangible, something that will hold value no matter what happens to the financial system. And that's the mindset shift that's happening right now. People are waking up to the fragility of the system. They're seeing bank failures. They're seeing currency crises in other countries. They're seeing their own purchasing power erode. And they're taking action. The silver stacking community has grown exponentially in the last few years. Online forums, YouTube channels, social media groups, they're all exploding with people sharing their stacks, discussing strategy, encouraging each other to keep accumulating. This is a grassroots movement. It's not being driven by Wall Street or Madison Avenue. It's being driven by regular people who've done their homework and reached the conclusion that owning physical silver is one of the smartest financial decisions they can make. And here's what the establishment doesn't want you to realize. If enough people stack silver, if enough people remove physical metal from the market, the paper manipulation schemes fall apart, because you can't deliver paper to someone demanding physical. Eventually, the music stops. We might be approaching that moment. The signs are all there. The supply deficit, the rising prices, the widening premiums, the inventory drawdowns, the institutional accumulation, the geopolitical shifts, the industrial demand surge. Every single indicator is pointing in the same direction. And that direction is higher prices and tighter supply. So when I say the window is closing, I'm not being hyperbolic. I'm reading the market. I'm looking at the data. I'm watching what the smart money is doing. And everything is telling me that if you want to stack silver at anything close to current prices, you need to act now. Not next month when you've thought about it more. Not next quarter when you've saved up a bit more. Now. Because next month silver might be $75. Next quarter, it might be $90, and the premiums might be so high that you're effectively paying $100 for metal that's quoted at $80. Or worse, the metal might not be available at all. Dealers might be sold out. Mints might be rationed. You might be on a waiting list with no clear timeline for delivery. I've seen this happen. I've watched people wait, thinking they were being smart, thinking they'd buy on a dip. And the dip never came. The price just kept climbing. And eventually, they either paid much more than they would have, or they missed the opportunity entirely. Don't be that person. Don't let analysis paralysis cost you. The research is done. The fundamentals are clear. The setup is obvious. The only question is whether you're going to act on it. Silver is real money. It's been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, hyperinflations. It's still here. It's still valuable. And it's still the best way for regular people to protect their wealth from the inevitable consequences of unlimited money printing. The governments of the world have printed trillions in the last few years. That money doesn't just disappear. It flows into assets. It creates inflation. It erodes purchasing power. And the people who understand this, the people who position themselves accordingly, they're the ones who preserve and grow their wealth. Silver is your hedge. It's your insurance policy. It's your way of opting out of a system that's designed to transfer wealth from you to the people who control the printing press. And right now, You still have the opportunity to stack at prices that, in hindsight, will look like an absolute gift. Because when silver is $150, when it's $200, when it's wherever this bull market ultimately takes it, you're going to look back at $64 and wonder why you didn't back up the truck. The closing window isn't about creating false urgency. It's about recognizing reality. The supply deficit is real. The industrial demand is real. The institutional accumulation is real. The geopolitical shifts are real. The inventory drawdowns are real. All of it is real. And all of it is pointing to a market that's about to reprice dramatically higher. So here's what you do. You assess your situation. You figure out how much you can allocate to physical silver without compromising your immediate financial needs. And then you act. You find a reputable dealer. You place your order. You take delivery. And you stack. You don't try to time the perfect entry. You don't wait for a pullback that might never come. You recognize that we're in the early stages of what could be a historic bull market in silver, and you position yourself accordingly. And then you hold. You don't panic sell on the first dip. You don't get shaken out by volatility. You understand that you're holding real money, real wealth, and that over time, it will preserve and grow your purchasing power in ways that paper assets simply can't. The silver stackers who started accumulating years ago when silver was $15, $18, $20, they're sitting pretty right now. They understood the fundamentals. They ignored the noise. They stacked consistently. And now they're watching their wealth grow as the market finally wakes up to what they knew all along. You have the same opportunity. The fundamentals are even better now than they were then. The supply situation is tighter. The industrial demand is higher. The geopolitical tailwinds are stronger. But the window is closing. Every day that passes, every ounce that gets consumed by industry, every ounce that gets stacked by someone else, that's one less ounce available for you. Act fast. Stack silver. Protect your wealth. And position yourself for what's coming. Because what's coming is a repricing of silver that will be talked about for decades. And you want to be on the right side of that move. The choice is yours. But choose quickly, because this window won't stay open forever.